I know it's right over here. Ask me
Dad,
what it is.
just ask somebody. Ask him right there. Huh. Hey, buddy, you lost?
Where is your weed whacker string?
Stay right here. I'm gonna find you some help, okay?
Oh, no.
Attention, shoppers. We've got a dad in aisle 47 that has no idea what he's doing. So when you see him, go ahead and point and laugh.
Home Depot stock, ticker symbol HD, reported earnings yesterday before the bell, and the stock was up 3.17% despite lackluster earnings when you look at the headline. So we're going to talk about why the stock was up, what does it mean for the consumer, and what does this mean looking ahead for 2026. But guys, before we dive in, if you could please go ahead, like and subscribe. It really helps me out. Now, you guys all know what Home Depot does. The world's largest home improvement retailer, specializing in providing products and services for construction, renovation, and maintenance of homes and businesses. And they offer everything from materials, tools, appliances, lawn and garden supplies, expert advice, everything. They have a plethora of stores, over 2,300 stores in total, 2,000 in the US and its territories, 180 or so in Canada, 140 up in Mexico. And when I say they were lackluster results, Home Depot actually missed on the top line, missed on the bottom line. Revenue did grow 4.8%, but the market just wanted a little bit more juice out of the revenue, a little bit more juice out of the earnings per share, which fell half a percentage point on a year-over-year basis. However, when you look at comp sales and the improvement from the same time last year, you're looking at quite a stark improvement, increasing 1% in comp sales for this quarter versus negative 3.3% last year. Net income margins were roughly flat. We saw a slight margin compression along with gross margins, and as a result, net income fell ever so slightly, inconsequential really, but free cash flow fell quite a bit from 4.6 to $3.72 billion thanks to the SIS acquisition. And taking on that acquisition, the company had $61 billion of debt, $2 billion of cash. In my opinion, a very ugly balance sheet, which really detracts from the overall valuation of the company. However, comp sales up 1% and big ticket comp transactions, which is $1,000 plus, up 3%, as you can see right here. Now, this is actually a stark improvement from what we've seen over the last, I would say, 10 or so quarters, coming out of the massive pull forward we saw here during the 2020-2021 COVID everything bubble. But to see this number improve is actually really good. And it does look like we are finally normalizing back to these pre-COVID levels, which you could say were 3 to 5%, somewhere in that range. Very positive stuff. And the CEO did actually come out and say 12 of its 16 merchandising departments posted year-over-year sales gains, and year-over-year sales trends improved in each month of the quarter, with comparable sales up 0.3, 0.5, and 3.3% in May, June, and July. That is what the CFO McPhail said. Now, as a result of all of this, revenue is up 4.9%. Home Depot managed their expenses really well. Cost of sales is only up 4.8%. However, despite operating leverage being built into the business right there, operating expenses was up 8.7%. Very ugly stuff. And this was in large part just due to selling, general, and administrative expenses right there. So the cost of labor are slightly higher, and that maybe could be attributed to the Trump administration. There's a lot of reports of ICE raids at Home Depot. So, having to take on American workers, that sort of thing, which is good for America, by the way, is, hindering their operating expenses. And maybe they're starting to feel that. So that could be a bit of a headwind looking ahead. But nonetheless, coupled with the fact that the company has such a high interest expense, which increased 0.3%, paying almost $500 million, nearly $600 million a quarter interest expense. That is why net income actually fell 0.2%. But why was the stock up 3% after those earnings? I mean, look, the earnings weren't particularly great if you look at, the granular details, but the stock was up 3%, and it had to do with guidance and a couple of other key performance indicators. Now, comp sales leveraging their digital platform, pretty much buying online, was up 12%. Very solid stuff. This is coming off a huge base as well. And also they began rolling out their generative AI tool, Magic Apron, to essentially, design your rooms, your tables, that sort of stuff, colors, very solid stuff. And you can see that this right here is definitely translating into comp sales, especially online. And that's what you love to see. This will probably also be the more margin accretive line of their business. And so to actually see that grow, the market tends to like that type of stuff. Also, the management reaffirmed its guidance, and it's very obvious the market was looking for a lower of its guidance. They reaffirmed 2.8% sales growth, 1% comp sales growth, and 13 new store openings. You can have a look at the rest. But all in all, they reaffirmed guidance. The market was looking for, a lowered guidance. And as a result, the market extrapolates out to the consumers looking good. Home Depot, which is a barometer for the economy, is looking good. And as a result, the stock was up. Even if you double miss, as long as your guidance is okay, as long as you're forecasting strength looking ahead, the market will actually ignore it. Something else the market was looking at was actually price increases. So in Q1, Home Depot came out and said, we're not going to raise our prices because of tariffs. This quarter, the CFO said, we will be raising our prices because of tariffs. So, and expect this trend to continue with a lot of other companies. You should see them raising prices as of tariffs. Home Depot will eat a little bit of tariff, China will eat a little bit of tariff, and the consumer will eat a little bit of the tariff. Looking at some other stuff the CFO said, they also didn't embed any rate cut expectations into their guidance. So, there is upside in that view. And again, the market extrapolating that because it's very likely we are going to get 25 basis points worth of cuts in September and potentially up to 125 by the end of 2026. And that is a real tailwind for Home Depot. Now, the management TV come out and say the number one reason for deferring large projects is general economic uncertainty as well as labor availability. That's very interesting. So labor supply is a real issue at the moment here for Home Depot. And then in an interview with CNBC, the CFO said the company continues to see effects of the deferral mindset. And that's just because this higher for longer environment just means that people are going to defer their projects to another year when they have lower rates, when they can actually go ahead and refinance their house and add that renovation piece at a much lower rate. Instead of having a 6% mortgage rate, they'll have a 5% mortgage rate, a 4.5% mortgage rate, and that is tangible because now they can afford that renovation piece, the sunroom or the pool, whatever it is. Now, the thesis for Home Depot looking ahead is ultimately we get those rate cuts, right? We see a pickup in building permits. People go ahead and renovate their houses, and cheaper credit allows consumers to go ahead and renovate their house. And Home Depot is at the forefront of that, right? And if that thesis does come to par, then in that case, Home Depot should do really, really well, especially when you look at where their figures are now, what they're guiding for, and beating off those expectations. However, how much is already priced into the stock? Because look, it trades at quite a premium, 25 times PE. That's 3 points above the market multiple of 22 or 21 times. Trades at a 17 EV to EBITDA, and it's got virtually a 0 shareholder yield. And this is how I model out Home Depot's valuation, right? So you put in the trailing 12-month revenue and you grow at 3.5% looking ahead. Net margins increase from 8.8 to 9.7%. These are just consensus Wall Street expectations. By 2029, you're looking at 19 billion, right? In net income. Apply 22 multiple, which in my opinion is frothy, especially because the company's growing less than the market and margins are less than the average S&P 500 company. The S&P 500 margins for this quarter is 12.8%. They're coming in at 8.8%, significantly under the market multiple and growth rate, by the way. So we're going to use the market multiple, but I think this number should be closer to like 17 or 16. But using a 22 multiple, we get the enterprise value, subtract the net debt. They have $62 billion in net debt. Absolutely crazy. Then you get the equity value, divide by shares outstanding, which is decreasing 1% sequentially. Then you get a share price of $376 in 2029. Current share price is $407, right? So you're looking at a compounded annual growth rate of negative 1.57%. A fair value of about $213 per share. So Home Depot is not a buy. In fact, to me, based on this, it would be a sell. But the market doesn't think so because the stock was up 3% today, as you can see from this candle, and it's looking near its all-time highs. This is in a very clear uptrend. You can see here you got a low, a high, higher low, all-time high. Then we actually pull back and we put in a higher low, as you can see relative to this low right here. And now we're making our way back up to all-time highs. This is a simple trend continuation. And I do think Home Depot will see its all-time highs with these earnings. I think the stock is ridiculously overvalued. It should be trading at a 15 PE, but I am not the market. And the market can remain irrational longer than I can stay solvent. But guys, if you've made it up until here, thank you so much for watching. If you liked the video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.